Good afternoon, traders. This is Shane with Futures.io, the best futures trading community on the planet. We are pleased to have you here, and thank you for joining us. Today, for FIO's 412th event and my first, we are talking algos. In the house, we've got one of the masters of algorithmic trading. It's Kevin Davey of KJ Trading Systems. He's got 30 years of experience. He's a best-selling author of multiple books on the subject, a champion trader, and a 3-time trophy winner at the World Cup of Futures contest. I'm sure you guys have seen the bullet points. If you're like me and you've never dabbled in this stuff before, this is going to be a great insight into the world of algorithmic trading. If you're more advanced, I bet there's going to be more than a few nuggets of valuable information. After the presentation, we're going to have a Q&A session with Kevin. So if you got a question, go ahead and type it into the question box. If we run out of time and don't get to it, fret not, because yours truly is going to be posting them afterwards on the webinar thread over at Futures.io, and you can get an answer directly from the man himself. The event is being recorded. It will be posted on the Futures.io website and YouTube within 24 to 48 hours. For those of you who have never been over to Futures.io, I encourage you to cruise on over to the site and check it out. We've got a great community, and it's an awesome resource. We've also got a ton of great content over on our YouTube channel, covering just about every trading topic you can think of. You should definitely check that out. And while you're there, pound that like button a couple times, share it with your friends, and subscribe for all the latest updates. If you're a social media butterfly, you can follow us on Facebook and also on Twitter at Futures.io. And now, without further delay, please join me in welcoming Kevin Davey. Kevin, how's it going?
Great. Thanks, Shane. You know, you've got a radio voice. You've got that deep voice. Sounds like somebody's talking on the radio. It's really cool.
I appreciate it. Does it sound nervous?
No, not at all. Not at all.
All right, man. Well, I think we're ready to go here. I'm going to go ahead and hand it over to you.
Okay.
There we go.
Alrighty, and okay, so people should see my slides and should see me down in the corner.
Hey, there we go.
All right.
Looking good.
All right, so let's get started. I just want to thank everybody for showing up today and taking time out of your day to listen to me. And of course, thanks to Big Mike, Shane with his first webinar, Terry, who's done this for a while, Bob West, who you guys know if you've been in the forum a lot. He does a lot of moderation, so I wanted to shout out to him. And you know, anyone I might have missed with Futures.io, they seem to be growing. Every time I turn around, there's new moderators and stuff. So I just wanted to thank them for having me on again. It's been about almost a year since I did my last webinar here, so I'm kind of excited. Got a lot of neat things to show you today. So for those of you who don't know me, I'm going to kind of explain some of my background in a little bit. But first, here's where I am. There's a big map of the United States, and I'm in the point right on the shores of Lake Erie outside of Cleveland, Ohio. So it's inside that big red circle. And I just took this photo about 15 minutes ago. This is what it looks like out the back from my house. And you can see it looks all white and gloomy, but that's actually part of that is Lake Erie, which is now frozen, which is kind of neat because it gets real quiet when the lake freezes. And the other neat thing is sometimes there's breaks in the ice, and bald eagles seem to like the breaks in the ice. And so you'll see them sometimes walking along the ice and then actually going over and sometimes grabbing fish out of the little holes that develop in the ice. So it's winter time in Ohio, and this is what you get. It's kind of cold, but it's pretty nice. Anyhow, Shane mentioned the YouTube channel for Futures.io. I have at least 5 that I could find real easily, previous webinars that are on there. So if you've never listened to any of my webinars and you like today's webinar, you know, go and check some of those other ones out. Usually what I try to do when I do these webinars is give you information that is more or less timeless, that, you know, it's not dated, and it should still be pretty valid. So you might want to check that out. Spend some time on YouTube listening to me if you want. And before I actually get started, just want to throw out this disclaimer. this is a real good disclaimer for those of you in the US and everywhere, really. Past performance is not indicative of future results. Don't risk more money than you can afford to lose. Treat all results as hypothetical. If you follow the things in this disclaimer, your trading's going to get better. It's really weird, but you're not going to fall for a lot of the traps where, you know, somebody on Twitter will show you this, hey, I made all this money yesterday, and you'll think you can do it too. Maybe you could, maybe you couldn't. You got to watch out for these kind of things. You know, you don't hear people on Twitter saying, oh man, I lost so much money yesterday. But the flip side is you always hear when they make money, right? And there's a reason for that. And so that's what you got to watch out for, because things like Twitter, stock twits, boy, it'll really make you feel like a terrible trader, because you look at that and everybody's making money except you. So make sure you keep this disclaimer in mind as we talk about things today. So my goal in the next 60 minutes, give or take, it might run a little long, might run a little short. But what I really want to do is just kind of demystify the world of algo trading. So I'm kind of coming into this first at a beginner's level for those of you who don't really know a lot about algos. And then we're going to kind of go into sort of an intermediate level and even advanced. We'll talk about some advanced things too. So we should pretty much hit something for everybody. But, you know, I obviously want to start out with people who are like, what's algo trading? I don't even know. And that's where I'm going to start. So I'll give you a quick intro on me. Then we'll talk about the basics of algos. You know, what does it all mean? And then I'm going to talk about 3 common misconceptions that people have about algorithmic trading, and then 4 big mistakes that people make when they're algo trading. And then we're going to build a simple algo. Now, what's interesting is when I first put this agenda out there, and there's a thread at Futures.io, a member, S for Scott, I believe, Hodson, he came up with one that he actually just mentioned in the thread about, hey, here's a simple gold algo. You buy Thursday afternoon right before the close, and you sell Friday right before the close. And I'd heard about this a few years ago. There's actually a hedge fund that supposedly uses this. The theory, whether or not it's true or not, I don't know. But the theory is that physical users of gold, so like jewelers and that kind of thing, will place their orders on Friday to buy gold. And so if you get in before they buy, you know, they buy and bring the price up. So the theory is Fridays are up days. And you can see how it performed the last almost 15 years, 14, 15 years here. And that's with costs, you know, it's just buying one contract of gold. It did pretty well. It had some pretty significant drawdowns, but, you know, thanks to Scott, who's definitely, and I hope his name is Scott, I think it is. He's in California, and I've promised next time I go out to California, I'm going to touch base with him. He's somebody to definitely to follow on the site. He has a lot of good information and a lot of insightful posts. So keep an eye out for him. The link to the site is down at the bottom, but if you just search for it for this webinar, you'll find it, and we discuss this. And then another trader actually took this a step further and started looking at the ES with this simple system. So there's a lot of good information that's already in the forum regarding this webinar. So take a look at that. But this is a good example of a really simple algo, and seems to work pretty well. So wanted to kind of add that in there. So just an intro for me. Probably most of you know who I am. For those of you who don't, you know, I've been trading for about 30 years, and I've written 4 trading books. They've all been bestsellers. as Shane mentioned, 3 times I won a trading contest trophy for a year-long trading contest, finished either in first or second. I've been able to also teach a lot of traders, and there's actually 6 people who've won that same contest or finished in the top. There's been 6 of them so far. And then I do some teaching on the side, and my students have been able to develop quite a few trading systems on their own that have worked in real time. So I've been able to kind of talk the talk by doing it, trading on my own, and also teach other people to do it too, which I think is important. And if you subscribe to Technical Analysis of Stocks and Commodities magazine, which if you don't, you probably should, because it's a great magazine. But in 2020, I won first place for Article of the Year. I write a monthly column for the magazine, and I finished in first place for that. And I actually finished in third place for Trading School of the Year, which was kind of interesting because the people that beat me were Thinkorswim and TradeStation, which are huge companies, and here it's just little old me by myself, and I was able to finish in third place. So that just kind of gives you some background, and it's a little bragging, and I apologize for that, but hey, you got to do it, right? So let's kind of go on. Let's talk about algorithmic trading. This is what a lot of people that I come in contact with when they say, what do you do? And I say, well, I'm an algo trader. And you know, I'm at a party or something, people just kind of and walk away or run away from me. Then they want to talk to the algo trader because they don't know what it means. And even most traders hear that word algo and they get scared because it sounds kind of intimidating. Algorithmic trading. So I'm going to demystify that for you today. But here's 2 reasons why traders get scared of algos. You know, this was back in 2012 where Knight Capital basically had a code error, and it cost them $440 million. And I believe they got absorbed by somebody else. They couldn't even survive it. And then even last May, you know, the algos were partly responsible for oil actually going negative. And the other bad part about it was a lot of brokers couldn't handle negative prices. You know, their internal algos for pricing and quoting didn't work. And so, you know, people hear those kind of things and they're like, man, you know, computerized trading just sounds kind of scary. And that's why they stay away from it. But you don't really have to be that scared. For those of you who are of a certain age, you will definitely recognize that photo there. There was a TV show called Lost in Space with a robot, and that's what people fear with algo trading, that this robot's just going to go crazy and start doing stuff. Usually doesn't happen, but I will say it did happen to me last year. I was trading a micro ES, thankfully, strategy, and there was a small bug in the strategy where around 4:15 you can see what happened. These are my actual trades where it was just buying and selling and buying and selling. I was really almost literally buying and selling with myself for that minute or so. I think I had like 100, 200 orders. I don't even remember at this point, but it was just algo trading run amok because it just buy, sell, buy, sell, buy, sell. And I went back and looked at it afterwards, and during that period of time, I think I was responsible for like 25% of the volume. And I'm surprised I didn't get a call from the compliance department at TradeStation or somebody else saying, you know, what were you doing? Why were you trading so much? But I was actually sitting in front of my computer when it was happening, and it just freaked me out, and it took me a while to kind of get under control. So people do freak out with algo trading because things like this can happen. So But that's why we test, and with the micro ES, it's a nice way. This whole disaster only cost me probably $100, I think, just in commissions, because usually I was just buying and selling at the same price or losing a tick, which in the micro ES was only $1.25, so it wasn't that bad. But that's why people are scared of algo trading, so I understand it. For a retail trader, algo trading can be pretty simple though. Here's an example algo. If the close is less than the average close of the last 5 bars, go long. And if it's greater than the average close, go short. This would actually be sort of like a counter trend type thing where, hey, if the market's going down, you're expecting a return back to normal, so you go long. But the neat thing is, once you create this code, you can apply it anywhere. You could apply it to stocks, futures, Forex, crypto. You could even do it with options if you were set up properly. But that's an example of an algo. Now, I'm not saying it's not necessarily a good algo. I'm not saying you're going to make money with it, but I'm saying it's at least a start to an algo that will generate trades. And you can automate this with most software, most trading platforms, with multi-charts and Ninja and TradeStation. And if you used like Python, you could do it. So you could automate it, which is pretty nice too. Then you don't have to necessarily be watching the charts all the time. You could be trading multiple markets, and that's one of the benefits of algo trading, which I'll get into. So, and here's another example where I actually am trading the 30-year bond in this case, but I'm using UTY, an index, to generate the signals. So I'm using other data to generate signals for what I want to trade. So you can do a lot of really cool things with algo trading that a lot of people don't do. Most people will base their decisions on the 30-year bond on the price of the 30-year bond, right? The futures. But you can do a whole bunch of different things. If you wanted to, you could base trading signals for the 30-year bond off of soybeans or orange juice. Now, I have no idea if it would work. It probably wouldn't, but you get the point. So algo trading, you program something and you just feed it data and it can do almost anything you want, which is kind of neat. So when you boil it down, algo trading is just a set of rules that determine when to trade, okay? They just tell you when to buy and when to sell. So you don't have to stare at a chart and say, oh, there's a higher high with the doji bar and the 60-minute time frame's looking good, so I think I'll buy here. You don't have to do that. You just let the algo take over and it buys and sells. Now, that's where a lot of people freak out because they have trouble letting some computerized rules take over. But if you back test your strategy, that helps give you some confidence that what you're doing might actually work. And once you do that, you can also automate what you're doing. So that kind of offsets some of the the scariness of letting a computer do your trading for you. And it kind of works out, it can work out pretty well. So a part-time trader who's just, calculating moving averages and crossovers by hand and generates trading signals, that's algo trading. Now, 10 years ago, they never called it algo trading. They called it systematic trading or mechanical trading, but it's all the same thing. It's just somebody came up with the word algo trading and it kind of stuck, and so now everybody uses that. The same token, PhDs who work for hedge funds, they're writing algos. And, their code might be a lot more complicated. Might not be. You don't know. They tend to keep that stuff secret. But you saw the example we had earlier of the real simple gold strategy. A hedge fund actually did or does trade that. Now they might put position sizing on it and some other stuff, but the point is that's a simple program and a hedge fund's trading it. So you can have simple strategies, complicated strategies, you can have the whole big thing, and they're all algos. So the big thing with this is don't be intimidated by the word algo or the word algorithmic. It's just rules to trade by. And as long as you understand that, it's not so scary, okay? And I'll show you how it's not scary in a little bit when we build a simple algo for gold. And you'll see, oh, hey, it's not that bad at the core. It's just rules. That's all it is. So given that, there's a lot of advantages for traders. So if you're thinking about algo trading, here's some advantages that you should consider. The big thing is you can test the rules for yourself. You don't have to rely on some quote unquote guru. And we've all seen these guys, right? These guys who claim to have trading rooms where, they win all the time and they'll show you a spreadsheet of results, but you get the feeling they don't trade. Last week there was somebody, I saw a YouTube channel of somebody who claimed he was a great trader, and it was obvious he was just sim trading. And so you were just kind of relying on this expert, for lack of a better word, to tell you what he was doing worked. Well, man, I don't know if you're like me, but I don't like that. I like testing something on my own and verifying it. And that's what you could do when you create your own algos. Or even if you use someone else's algos, if you know how to test them, you can still verify they work and that they worked historically. Now, you might say, well, hey, past performance is not indicative of future results. That's true. And I'll tell you, I've done studies of millions of back tests. And what I found is when you have a profitable back test, you're more likely to have profit going forward than if you have an unprofitable back test. So it's not absolute by any means, but it kind of skews all the odds in your favor a little bit. So if you have a good back test, chances are you have a better chance of it working in real time. But that's why you back test, and you can do that with an algo. And the other cool thing, probably the biggest advantage of algo trading, is you can create a whole bunch of strategies, different markets, different bar sizes. You can do crude oil 30-minute bars, and you can do crude oil daily bars, and as long as they're uncorrelated, you can take advantage of diversification. Now, a lot of people probably don't realize how powerful diversification is, and I could spend an hour easily talking about that. But just to let you know, if you trade uncorrelated strategies, which you can do in futures, cocoa, you have a cocoa strategy, it's probably not going to be the same as a gold strategy performance-wise. And maybe the two of them together kind of balance each other out. That's what you look for. So diversification is huge. People are always looking for the holy grail. I always say the closest thing in trading to a holy grail is being diversified. It really can smooth your equity curve. Third point, if you know something's worked in the past, you have more confidence in it, and you're more likely to keep trading it. And that's a big one, because you definitely need confidence in whatever you're trading. I see a lot of people who just start trading some discretionary method based on something they read somewhere, and they have no idea if it works or not. What usually happens to those people? Well, they start trading it and things go wrong, which normal trading, you're going to get drawdowns. And after a week, they haven't made money. And so they say, oh, this method's junk. And they throw it away and go on to the next method. And they constantly search for methods where if they stuck to something they had confidence in, they would have kept going with it and it probably would have worked out better. So having confidence in your strategies is a biggie. You don't have to be glued to a screen. You know, we've all heard stories of discretionary traders with 8 monitors and, you know, they're looking at all this stuff and can't go to the bathroom and, you know, can't take any breaks the whole day because they'll miss something. Now, with algos, you don't have to do that. You know, you still have to monitor your algos, definitely, but you're not glued to the screen anymore. And you're in control when you create your own algos, okay? Somebody out there might want to only trade on Thursdays for whatever reason. Well, hey, go and create an algo that only trades Thursdays. Or you don't want to hold any weekends. Well, create an algo that does that. You're in control of it because it's whatever you pick as an idea and whatever you program as a strategy. And that's huge. Being, you know, because you get that feeling of being in control and you also get something you like. For those of you familiar with Dr. Van Tharp, I follow a lot of his stuff, but his big thing is you have to trade strategies that fit you as a person. And this is a good example of that. You know, you build algos that you feel comfortable with and that satisfy whatever you want out of the markets. And that's a big one. The other thing, you don't stress about every single entry and exit like you would with discretionary trading. So I think your stress level goes down a little bit. But at the same time, that stress level doesn't disappear completely, which is going to be one of the disadvantages. So, you know, those advantages are pretty nice. Confidence, and you get to back test and make sure something worked, and you don't have to be glued to the screen. Those are cool. But there's also disadvantages, and you know, don't go into algo trading thinking it's all rainbows and roses and sunshine and happiness, because algo trading is hard, just like any trading. You know, and the big thing is when people develop their own algos, it's really easy to screw it up and develop it the wrong way. Excuse me for a second, just needed a drink. So it's really easy to develop an algo the wrong way. And in fact, the way most trading software is set up, it's more or less intentionally set up to make you do dumb things and make you do bad things, because the trading software wants to show you the best results, meaning optimized, and, you know, doing that kind of stuff is terrible. So you got to watch out for that. And like I said, just because something worked for the past 20 years doesn't mean it's going to work for the next year or the next 6 months or even the next week. There's no guarantee. And you got to realize that, and you got to account for it. But once you realize it, it's not so hard to deal with. The other one, I see it over and over again. People take a strategy that's pretty decent, and then they start tweaking it, and they start adding filters and adding other rules and try to make a better back test. And I'll talk about this some more, but that's not what you want to do at all. And then a lot of people can't resist overruling their strategy. So I'll give you a good example. There was somebody I was talking to a couple of years ago who had a Forex system, and he was going to go live with it. And he had like a $5,000 account. And so I said, well, good luck, you know. And after that, the first week was out, I emailed him, how'd you do? And he said, well, I made $500. I'm like, hey, 10% in 1 week, that's pretty good. He goes, yeah, but I overruled my algos because there was some kind of Fed or central bank announcement or something like that. I would have made $1,500 had I just followed the algo. I'm like, ooh, that hurts. And the thing is, I talked to him a little bit later. He never really learned that lesson. He was still overruling his strategy. People, for some reason, think they're smarter than the algo they created. It must be human nature, but it's dangerous. Now, a lot of people think it's set and forget. You know, you might have, if you've been around trading for a while, you probably remember the EA, the expert advisor robots for Forex that were really big 10 years ago, where there was all kinds of ads for, hey, just run this bot and walk away and come back a week later and you'll be richer. Just total BS. But a lot of people have in their mind that they can just start the algo and walk away and not have to worry about stuff. But one, you know, there's rules with the exchange that you got to have supervision of algos. You know, they're pretty lenient on what supervision means, but it doesn't mean turning your algo on and going to Tahiti for 2 weeks without checking anything. That's not supervision, right? And because problems happen, internet outages, there's rollovers in futures, there's all sorts of things that you have to deal with pretty much on a daily basis. You know, you got to check and make sure your positions are lined up correctly. So that's a big disadvantage because a lot of people think their life is going to be super easy. And it was funny, before the event started, I was talking to Shane offline, and you know, he mentioned, he was like, well, you know, you develop algos and now you're not sitting around trading all day. And I said, well, technically I'm not sitting there trading, but what I am doing is sitting there creating new algos, and in the back of my mind also watching my algos for problems that might show up. So it's not like you can just walk away, and that's a disadvantage that a lot of people don't realize. And it's hard work. It's like anything though, right? I mean, you know, was LeBron James always a great basketball player? Sure, he had talent, but he works really hard. Was Tom Brady always a great quarterback? No, he works really hard at it. Takes hard work to succeed in anything, whether it's in trading, the same way, discretionary trading, algo trading, whatever kind of trading you do, takes hard work. And frankly, most people are just not cut out for the hard work. The bottom line, it's not for everybody. You know, maybe you're like the human on the left and you want to be a discretionary trader. Maybe you want to be like the robot on the right. Some people are better off with discretionary. I've tried it. I was never really good at it. In fact, I was pretty terrible. I'm a lot better at this robot building and robot type trading. So hopefully that kind of just gave you the pros and cons of algo trading for somebody who's thinking about getting into it. There's a lot to digest, and it's not something you can just jump into. There's obviously a lot of skills you have to have too. Okay, so maybe you're on the fence. Should you consider algo trading? A couple quick questions. Can you follow rules exactly all the time? If you can't, you're going to have trouble with algo trading. Can you develop a strategy properly? And you might say, what does that even mean? Well, that would, then your answer to that question would be no, not yet. Obviously, there's resources out there to help you with it, but you've really got to learn to develop a strategy properly. Are you a tinkerer? There are people who like to tinker with strategies and keep making them better. I mean, I literally know people who've spent 7, 8, 10 years building and working on one strategy. And every time they get a loss, they go back and they say, hey, what could I have done differently? And what kind of rule could I add to get rid of that losing trade? And so they do it, and then their back test looks great because they keep engineering out the losing trades, but real time, doesn't really work. So if you tinker, algo trading is going to be tough. And you got to be excited about the whole process. It's got to be kind of like a puzzle to you because it does get really frustrating at times. You know, when you try, say, 99 strategies and nothing works, but the 100 strategy works, you know, it's hard to live with so many failures, so many things not working. But it's hard work. And you're up against a lot of people who are trying to do the same thing. So it's not easy. Okay, so with that, let's hit on some common misconceptions about it, about algo trading. And this one might be my favorite one, and I hear it a lot. Algo trading, I'm going to algo trade because then I won't be emotional when I trade. It amazes me that people say that, honestly. And it tells me one thing. They're either paper trading or not trading at all. Because if they're doing either of those, then yes, algo trading can mean nothing. The fact is, if you've got real money on the line, any kind of trading, you're going to have emotion. It's just going to be a little different, algo versus discretionary. You know, I mentioned before, you don't stress out about every single entry and exit, but you stress out about other things. Oh, should I turn this algo off? It hasn't made money in the past week. Ooh, should it, or it's been doing real good. Should I double the size? And you stress out about it. Basically, as long as there's money involved, there's going to be emotion. And if you say, hey, the money doesn't matter to me, well, either you're trading so little that the money just doesn't add up to much, or you are a bazillionaire and losing a couple million a day doesn't really matter. You know, think of Elon Musk. He could be trading and he could lose millions a day and he probably wouldn't care. He'd probably have no emotion. So it's either you have so much money that it doesn't matter, or so little money that the amount's minuscule. But for most of us, where we're trading with meaningful amounts of money for our situation, for our net worth and our salary and all that, you're going to have emotion. So remember that. It's just different than you might be used to. Second misconception, a lot of people think, hey, use the computer to optimize. Optimizing is a good thing. You know, it can be useful. Don't get me wrong. I mean, I use it in the process I use, but most traders misuse it. They over-optimize. They curve fit. So if you don't know how to do it properly, my answer is don't do it at all. So going back to that bonus little algo that I showed earlier, there was no optimization there. And you could say, well, hey, I'm going to try, instead of buying on Thursday and selling on Friday, I'm going to try buying on Monday, selling on Tuesday, buying on Tuesday, selling on Wednesday. I'm going to try all combinations and see which works best. Bad idea, unless you do it a certain way. But it's better just to, hey, that's the idea. I tested it. Hey, it looks good. Maybe you go and trade it. It's better a lot of times not to optimize at all. And that's a good example of it. Third misconception, a lot of people think complicated strategies are going to perform better. You know, I've heard of people who go to a trading forum and they say, hey, I need a new computer because I built a a strategy, an algo that I was testing, and it took all weekend to run, and I want to reduce that time. And a couple times I've kind of jumped in there, which I shouldn't have, but I did. I jumped in there and said to the person, well, have you ever considered that maybe instead of a faster computer, you need a simpler system? You know, maybe 400 variables that you're optimizing isn't the answer. And what I found out, I don't do that anymore because I found out people don't like that kind of advice. You know, they already knew the solution to their problem, which was buy a faster computer, without realizing they're asking the wrong question, and they should be saying, hey, do I need such a complicated strategy? They assumed they did. The more complicated you are, the more curve fit and overfit your system is. It's pretty simple. And speaking of simple, simple works best. Usually works on unseen data. Now, people with complicated systems can create much better backtests than I can ever create. And I've seen that once. There was once where there was somebody on a trading forum who wanted to swap strategies. But they wanted to see my backtest and I would see theirs. Okay. So they showed me their backtest and it was just awesome looking. It was almost a 45-degree angle, straight line. And my backtest was realistic. It didn't look so good, had big drawdowns. And this person got really mad at me. What are you trying to do? You're trying to scam me by giving me a junky system. So we never shared them. But what we did share was, in a few months, we actually did share results in real time. And big surprise, my simple system did a lot better than the complicated curve fit system. So you got to remember that when you backtest. Simple is going to create a worse looking backtest, but it's going to tend to work better going forward. And that's, people have real trouble wrapping their head around that concept, but it's a big misconception. Okay, so those are 3 misconceptions. See, I just want to see how we're doing on time. Oh, we're doing pretty good. Here's an example of it. I have 8 optimized variables, lots of rules, lots of iterations. Here's the curve. It's not even that great of a curve. This is the back test, the optimized back test. Here's what it did in real time. And I swear I did not make this up. I just ran it and it fell apart during COVID. Okay. So then I took just a couple of the rules from this same system and I ran this back test. It's probably not as nice as the first one, but it's only got 2 optimized variables, only did 16 iterations. So I really cut down on it. And here's what it did. So where the other one failed, this one did really well. Now, you could say, hey, this is one example. It doesn't prove anything. Yes and no, you know, it's one example, but it just gives you an idea that, hey, you don't need to have tons of rules to get good looking performance that's out of sample, that's real time. And that's what we're looking for with the blue. Okay, moving on, 4 big algo mistakes. And I'll go through these a little more quickly. People think more data, you know, the longer the test they run, it's better. Well, not if it's in sample data. You want out of sample data. What does that mean? Well, think about your traditional optimized backtest. People will take all their data up until yesterday and they'll optimize it. So that's all the blue. And then anything from today going forward is going to be out of sample. It's going to be yellow. This is bad. You want the most yellow you can get. One way to get it is doing walk forward testing, where you step down and do each of these steps that I'm showing here. You get a lot of yellow. Years and years of it. And that's what you want. So having a lot of in-sample data doesn't buy you much. Another big algo mistake. Slippage and commissions are not important. And I see people do this all the time. And you want to know why? It's a secret nobody talks about, but without slippage and commission, a lot and probably most strategies you test will make money. Simple moving average crossovers, they'll make money. Breakouts, they'll make money. Just about anything you can come up with will make money when you don't account for slippage and commission. But when you add in slippage especially, it can kill a strategy. And it can also lead to over trading when you optimize, because it's going to tell you take as many trades as you can because there's no cost to it. Give you an example of what slippage can do. This was, I had a gold strategy. I was only trading one contract with it, thankfully. This was on Martin Luther King weekend, Sunday night. You see that huge bar. Gold dropped 20 points in like, I think this is a minute bar, I believe. And my strategy happened to go short right when this collapsed. And I actually had 14.5 points of slippage. So you tell me slippage does not matter? Come on. $1,400 per contract, slippage. And then, as you can see, I was short. Well, you don't, but I was short. You don't see it on that chart. But you can see the market went up. I was stopped out with a loss. So not only did I lose on the trade pretty quickly, I also got $1,400 in extra losses. So if somebody tells you slippage doesn't matter, man, you're listening to the wrong person, because it absolutely matters, and it can kill a lot of strategies. Okay, I'm off the soapbox now. Next big myth. A lot of people think the better the back test they can build, the better off they are. And usually, the more you try making a better back test, the worse your real-time performance is. Not always, but usually. And the key with this is you build a good back test, but not a great one. You stop before you tweak it and add too many rules. And if this doesn't make sense to you, just do it as a test. Just go and try to build some great back tests and then put them away for a few months. See how they perform in real time. What you'll find is the better the back test, usually, the worse the real-time performance is. Okay, and finally, before we get to building our algo, a lot of people think, hey, I'm going to do a short back test to keep it tuned with the market. So I'm only going to test for the last 3 months or 1 month or 1 week. I've seen people do back tests of 2 days because, oh, hey, this will be tuned to the market. But they're just kidding themselves. I'll tell you, the shorter the back test, they're a lot easier to create. You know, you tell me to create a system based on a 3-month back test, I could do it like that, no time flat. But if you tell me to do it on 10 years of data, it's a lot harder. And that's because a lot of times strategies just show up for a little tiny bit, and it's not even enough for you to exploit it. It might not even be a real thing. The more market conditions and scenarios and, bull markets, bear markets, flat markets, volatile markets, the more things you test your strategy over where it performs well, the better off you're going to be. And of course, that, like I said, it's much, much harder to do. Okay, so those are big algo mistakes. We've talked about the disadvantages and advantages. Hopefully, I've given you a good overview of algo trading. So now let's just build a simple one. And so you can kind of see this in action and what it's like. So first, we need a trading platform to do our testing. We need an instrument to trade. We need an idea to test. And some important notes. Any testing you do, or any trading you do, I should say, make sure you test first. This is really important. Don't take anyone's word for it. I've seen books where people say, oh, this is what you should do. And I've gone and I've tested what's in these books, and I don't know what they were smoking, but a lot of times what they say is good was terrible. So test it for yourself. And this example, I'm not going to go through all the steps I normally go through to develop a system, but I have a trademarked development process I use. And so this is just going to kind of touch on some of the things. So keep that in mind. I'm doing a real simple example just for the sake of this webinar. And because of that, I'm skipping many of the steps I normally do. Like I like to do walk forward testing. I like to do Monte Carlo testing. But I just don't have time to talk about it all today. Okay, so first, you need a trading platform because you want to do testing and hopefully automation, right? Now, I use TradeStation. I've used it for 15 years. A lot of people like to bash TradeStation because it's probably still the most popular one. At least every time I do a survey, it's the most popular. But there's a lot of other good ones too. You know, there's a lot of other good competition, and it's making everybody better. You know, I'm just listing some of the alternatives there. A lot of people are getting into Python and doing it themselves, and there's libraries out there you can do it. You can do it by hand if you want. The point is, you just got to come up with a way to test, and then if you really want to automate it, you know, you're not going to be able to automate by hand, but you're going to want some software to do it. So that's step one. Step two, and I want to mention step 1A, which is obviously you got to learn to program in whatever platform you're using. That's kind of a given. You need an instrument to trade. For this example, I'm going to take gold. And specifically, I'm going to take 30-minute bars of gold. Now, I could have taken 15 minutes, 22 minutes. You know, the sky's the limit what you can do, and you're going to get different results for different bar sizes. So I just took 30, thought I'd try it out. Now, you can do this, like I said, with stocks, Forex, whatever you want. I trade futures because it's nice to be able to get a diversified portfolio of you know, soybeans and the euro currency and heating oil. You know, you trade some different things. And also there's some really cool tax advantages with futures for those of you in the US. I mean, I literally could hold a futures trade for 1 second, and I forget if it's 40% or 60%. It's a 40-60 split. If I make a profit, either 40% or 60% is considered long-term capital gains. And I held it for a second. It's such a crazy law, but you know, that's the US tax code for you. It's a great advantage. And record keeping so much easier. If you trade stocks, you probably go every year to your accountant with a spreadsheet of all your stock trades. With futures, I get one number from my broker. It's my P&L, mark-to-market P&L for the year. So that alone saves you a ton of time. Okay, so anyways, so we're going to do gold. We need an idea to test. Okay, so here I am in Cleveland. There's my smiling face. And let's say I want to go to Los Angeles and I want to take a train, take Amtrak. You know, people don't really do that this much anymore, but people do. So be kind of cool. So if I want to do that, what am I going to do? Am I going to first go to Chicago, or am I going to first go east to New York and hope the train turns around and starts going towards LA? You're like, what kind of stupid question is this? Of course I want to go to Chicago because I want to go in the direction I'm headed. Yeah, trading can be the same way. I want to hop on a train that's going in the direction I want. Same way, I want to hop on a trade when price is going the way I want it to go. So I'm going to enter in the direction of the trend. I'm just going to follow the trend. hope it keeps going enough for me to make some money. And that's it. That's the whole idea. And one way to implement this is to say, hey, if the closing price of a 30-minute bar is the highest close of a certain number of bars, then buy the next bar at market, and vice versa to sell short. Okay, and I'm going to use a different parameter value there. I'm going to use LEN1 and LEN2, so I'm going to give it different lengths. A lot of times I just like to make it symmetrical. 50 bar high, I buy, 50 bar low, I sell short. Okay. And then look at exits. I'm just going to throw some simple exits in there. I'm going to have one variable I optimize, which is going to be that stop L. It's going to be a dollar stop. And then I'm going to put a break-even stop, which is going to be twice the stop loss value. I'm going to set a profit target at 3 times. So let's just say I had a $1,000 stop loss. If I lose $1,000, I'm out. Now, if I hit $2,000 profit, I move my stop up to break even. So the market might fall back down, but I'm going to get out break even. And if it hits $3,000 profit, my profit target gets hit and I get out. Pretty simple. Okay. Now, I just use these for examples. These aren't always the best. And in fact, if you visit my website, I have a nice study. I did over 500,000 back tests where I reveal what I found was the best exit to use. And it's going to surprise a lot of people because it surprised me. But it wasn't these guys. But I just wanted to build one with it. So here it is. Here's all the code. This is TradeStation format, which is easy language. I think anyone can look at this and pretty much read it and understand it. Maybe you don't quite get, excuse me, the syntax, but you understand, at least on a top level, what's going on here. So I have 3 variables that I'm actually looking to possibly optimize, and there's my code. That's it. It's pretty simple. I'm also going to use very few iterations, so I could do every dollar stop from $1 to $1,000 and have 1,000 iterations. I'm not going to do that because that's just silly. I did 30-minute bars, but I also did pit, what were the traditional pit hours. And now some of you might be like, what in the world's the pit? Because you're used to electronic trading. But back in the old days, when this was physically traded by people in New York, they had a pit where they would buy and sell. The traders would do that, and it went from 8:30, I think it was 8:30 in the morning to 1:30 in the afternoon. So those are still the most active hours for gold. So I'm going to use those to reduce the slippage because I want to trade only when the market's active. I don't want to do that Sunday night holiday trade where I got $1,500 almost of slippage. I didn't do walk forward testing, but I wanted to do in-sample tests from 2007 to July of 2019. And then from July 2019 to present, which is about a little over a year and a half, is my out of sample test. So that's kind of my verification that it works. And that's just what I said there. Okay, so here's the in sample. And yeah, it looks all right. It's kind of going up and to the right. Has some significant down periods. You go a couple hundred trades here without hitting a new high. A lot of people wouldn't like that. But again, that's the danger in this, is you don't want to look at this and then think, oh, I'm going to add a rule, some kind of rule to make this look better, and then you do something that looks better. Let's say I'm going to try drawing here. Let's say your second iteration looks like that, and you're like, well, I like that equity curve a lot better than this one, so this one's out. Kevin's idea that he's a jerk. I'm not going to listen to him. I'm going to do this because this one's better. I created a better back test. That's a big mistake. Don't do it. You can't keep going, because you do that and you're just going to, eventually the data is going to give you a great result, and it doesn't really mean much. The true test is how it looks out of sample. And here's those people shouting at me, you know, hey, I could do a lot better. And those are the drawdowns that you're trying to eliminate. Don't do this. Because I definitely agree with you. The backtest could be a ton better. But the key point is, you got to remember that is not the goal. People get confused and they think building a great backtest is the goal. It's not the goal at all. The goal is in yellow right there. I'll let you read it. It says good risk-adjusted performance in real time is the goal. That's what you got to aim for. And here it is with this system. Now, it made what, 10, 20, roughly $30,000 in a year and a half. It had some significant drawdowns over $10,000. So it's, you know, a lot of you might be scared of it from a risk basis. That's fine, but it continued to perform well. It didn't do what probably most of you are used to with systems, where it did this. And if you've never created an algo that did that, my hat's off to you, because I can tell you, for the first couple of years of me creating algos, this is all I created. I just created, every system I created just collapsed in real time until I figured out what I was doing wrong. And once you figure that out, then you can start to make adjustments. Okay, so let's just look. Here's the two algos. So the bonus one that the Futures IO member gave us earlier, that's the orange line. And you can see the one I just gave you right there. This is just year by year results. You know, they both have drawdowns. You could argue you want to trade one or the other, but the key is they're both simple algos. They weren't over optimized, and they both have worked and worked in real time, and that's kind of neat. Okay, so that's our algo. Pretty simple, and you know, for some people that's maybe all you need if you like it on a risk-adjusted basis. But where do you go from here? If you've maybe I've kind of whet your appetite for, hey, maybe I'll think about this algo trading instead of discretionary. There's a lot of things that I didn't touch on. You know, what's good performance? How do you do this development the right way? How do you over-optimize and avoid it? Should you do walk-forward testing, out-of-sample testing? What is all this? You know, how do you know when an algo goes bad when you're running it in real time? There's a ton of questions. This is not an easy topic that, you know, you're all of a sudden going to start tomorrow and create your first algo. I wish it wasn't that way, because my life would have been a lot easier. That's something I would have done years ago, but this took me years to kind of figure out the answers to these things. And for me, it was losing money doing it, because I always tried to put real money on the line. And I don't know if that was really that wise of a decision, but because I got beat up a bunch, but I ended up coming through the other end. The big thing is, starting out, you don't even know what you don't know with this, and that's what makes algo trading hard. But one key takeaway, if you're going to think of doing this, don't do this. So if you learn nothing else from today, don't do this. Don't call up a chart, stick a strategy on it, optimize it to death, and then trade the optimum results. Just don't do it. And I'll tell you, this is what most people do. Because one, it's easy. Two, it gives you those great looking back tests. It gives you that false sense of security. And you think, well, hey, this has got to be right, you know. Well, even if it doesn't do as well as it did historically, it'll still make money. For some reason, the market really knows when you optimize things and optimize too much, and it doesn't like it. And if you avoid doing this, you're going to be ahead of most people trying to do algo trading. Okay, so in case you're interested in starting this, what do you do next? Well, obviously you got to get a platform, a broker that supports all the stuff you want to do. You know, read some strategy development books. Bob Pardo has a great book. Tomasini, Dr. Ernie Chan, and I've added myself in there, but you know, there's a lot of good strategy development books out there, and there's a lot of help you can get. You can get help on the Futures.io forum. There's a lot of people who are doing this stuff, but eventually you got to get to the point where you just start developing a strategy, and you got to kind of fumble through it a little bit. And the neat thing about the micro contracts now, you don't have $50 a point, you have $5 a point, $1.25 a tick. It's an easy way to just kind of stick your toe in the water. You know, you don't have to jump in and find out it's freezing cold. So that's how I'd start. And then once you develop that first strategy, just kind of go on and rinse and repeat. Because the one thing you want to do is create better strategies, more strategies for more markets. And your approach will probably change. You know, maybe your first strategy, you realize you did something wrong. Well, then you go back and you update your process and you get better at it over time. It's not something that is one-time shot and now, you know, you do it tonight, tomorrow you have all the algos you'll ever need for the rest of your life. It's not going to work like that. It's kind of an ongoing thing. I mean, I've been doing it for years and I'm still creating algos. I've got a laptop running right to my right here that is literally running millions of cases, millions of strategies and stuff because I keep looking for new algos. Okay, so with that, kind of sum up, hopefully algo trading is not so scary anymore. If you were kind of intimidated by it, hopefully I've kind of brought it down to a simple level. There are people out there who make it sound like just incredibly complex thing to do. You know, I've read papers by people who are algo traders who just try to belittle the reader by just making it so hard to understand. It doesn't have to be that way. It can be pretty simple. Just like anything in trading, it has its good and bad points. It's not for everybody. There's no guarantee of profit, obviously. There's no guarantee of not having drawdowns. There's good and there's bad to it. And it's not for everybody. There's a lot of people who can't do this type of trading. And, you know, I know some people and have heard of people who can look at a chart and see patterns that no one else can see. But they can't program at all. So they probably wouldn't be a good algo trader. Maybe they'd be a good screen trader. And if you're going to do it, take the time to learn to do it the right way. And this holds no matter what you do. Algo trading, discretionary trading, make sure you learn to do it the right way. Just don't hop in and think you're going to start trading successfully because most people lose. And that's one reason why. And, you know, maybe I made this look too easy. It's hard to do it. It's hard to do it correctly. And I always tell people that, you know, a lot of people email me and say, hey, I retired. And with COVID, I was forced into retirement. I need to make some money, you know, starting next week. Help me algo trade. And I'm just like, I can't help you. I tell them I can't help them and they get mad. But I'd rather be truthful than try to lead somebody on with something. It's very hard to do correctly. Okay, so with that, I know I went over a little bit, but I want to thank you for listening to me drone on for, what was that, 70 minutes. But I'd like to turn it over, questions and answers. If you want to send me an email, if you don't want to ask it now, kdavey at kjtradingsystems.com. Just send me an email and say, hey, I listened to the FIO webinar and I have a question for you. I try to answer all the questions I get. And with that, I'll let Shane turn his microphone back on, and maybe you can read me some questions. I don't know if I have access to those questions. No, I don't. So, Shane?
Yeah, all good, man. Great presentation. I'm personally very curious about all of this. You've presented it in a fashion that, even makes it accessible to a discretionary trader. It's pretty intriguing stuff, man.
Well, thanks.
Yeah, we've got some questions here, though. So the first one, hang on a sec. Really kind of covers diversification. The question is, first of all, what minimum account size would you start with? And then the second question is, how many strategies would you start with to get enough diversification?
Good. Good questions. First of all, as far as account size, it really depends. It depends on a few things. And so I can't give a dollar figure. One, because I'm not a registered advisor, so that would be giving, very personal advice. So I can't do that. But what I would look at is look at the markets you're trading, and that will give you an idea with the minimum margin requirements and that kind of thing. And then look at the strategies you're trading. What kind of drawdowns did they have historically? And, when you add up these strategies, what does your equity curve look like as far as drawdowns? And then, so that's another part. And then you got to look at your risk tolerance. So I might have a risk tolerance where I'm very aggressive and somebody else might be more conservative. And so those are three big things that are going to help you determine what kind of account size you need. So that's one thing to look at. Then as far as the number of strategies, the more the better usually, but I like to tell people, hey, if you have 5 uncorrelated strategies, you're probably going to be in a decent spot. But if you have 10, you're going to be a little bit better. I mean, I've traded at one time up to like 50 or 60 strategies. I've since scaled back just as I've gone through trading, and now I probably trade like 30 or 40 different strategies, different markets. Not, some are the same markets, but they're uncorrelated strategies for the most part. But you don't want to trade 1 or 2 strategies, because you're relying too much on their performance. And the example I always give to people is, let's say you're going to open a Subway restaurant, that makes subs. And so it's a fast food place, and you got to hire workers. So you hire one cashier, and that cashier is going to be your cashier all the time you're open. Let's say that person's stealing from you and you don't know it. Well, pretty soon you're going to run out of money, right? Your business is going to fail. But let's say you had 5 cashiers and one of them steals, but the other 4 are honest. Well, it's going to take you a lot longer before you see there's a problem, right? And once you do, you say, hey, you're stealing from me, and you just kick them to the curb, and you keep the 4 honest ones and hire another one. Same way with strategies. The strategy that's costing you money, if you have enough of them, it's not going to bankrupt you. So that's another way I like to look at diversification. Great question, by the way.
Yeah, I agree. Here's another one, and I'm trying to parse this, but the question is, do you always run your strats with a long or short entry, or do you, I think the question is, do you design a algo to run with one direction, or do you design algos that will run both directions?
That is a good question. So for example, that sample strategy we showed way at the beginning, that isn't mine, but I used something similar to that, and that was a long only strategy. So I tend not to like those. I like strategies that can go long or short, which for most futures instruments, except for the stock indices, which, you know, just seem to be going up and up. But if you're trading currencies, hey, it's a pretty good idea to be able to go long and go short. If you're trading crude oil, hey, you know, last year around this time, crude oil was way low and going lower. Now it's going higher. So you want to be able to trade both directions a lot of times. And you can create strategies that only go long and that only go short. My experience with that, though, is it's easier to curve fit because now you're only looking at one direction at a time. So let's say you did a breakout strategy long and a breakout strategy short. I like to combine them and use the same parameters long and short, and then I run less risk of curve fitting. So you can do both, but again, if you're going to separate them, I'd worry about curve fitting.
Yeah, for sure. Really good question here, I think. Do you need a VPS in order to keep your back testing algos running all the time?
No. That's the answer. No. Okay. So I'll go. That is a great question. So if you're using like NinjaTrader or TradeStation, it's only going to place orders when the software is running. Okay. So you either need it on your PC at home, or you can put it on a VPS. So for me personally, I have excellent internet connection here in Cleveland, and it almost never goes out. And I have backup internet, I have backup batteries, I have a backup whole house generator, I have backup PC in case you know, my hard drive crashes. I've got all kinds of backups of backups. So I feel pretty comfortable just running on my PC, but I'm running pretty much 24/7, 24/5. I'm running TradeStation, and I'm also running NinjaTrader because I do stuff with Ninja too. And I'm also running multi-charts. I'm running all three of them pretty much all the time. Now, you could say, hey, I don't have great internet connection. Well, then what you want to do is you could do a VPS, a virtual private server. So you run it on the cloud, and then you just remote in every once in a while. Now, there's a couple pros and cons to it. Obviously, there's a cost to it, and a lot of times there's some lag, and it's a lot harder to actually do development work on a VPS platform, at least I've found. But there are some great VPS. I'll plug Sam028 on Futures.io. He's, I think he's still a moderator to an extent too. He actually runs Speedy Trading Servers, which they're the outfit I've used quite a bit when I've done my trading with the VPS, because I have done it over time. But yeah, the short answer is you don't need a VPS, but you do need to have that software, your trading software, running pretty much all the time.
Yeah, very good. You know, it's really interesting. You know, there's a lot of parallels between discretionary and algorithmic trading. You know, I mean, it seems like, you know, people kind of suffer from the same problems in terms of like tweaking their strategies. You know, it's really easy to mess with stuff and just instead of just kind of letting it play out.
Yeah, that, I mean, it's big, and it's that's why I always say there's definitely emotion involved with algo trading, where people think they're going to get away with it without emotion when they get away from discretionary. But you go from worrying about trade entries to worrying about your strategies themselves. Should I turn the strategy off because the U.S. election is tomorrow? You know, that kind of thing. And you know, all it takes is a couple wrong decisions, and then you're really second guessing yourself. So yeah, you're right. A lot of those the same core doubts and lack of confidence show up in both kinds of trading.
Yeah, and it seems like there's a certain level of creativity required to, you know, develop these algos.
There is, the nice thing is there's a ton of stuff out there that people have already tried. And what I do for a lot of the strategies I come up with is I just modify what somebody else did. I'll take their idea. So for example, I did this recently with some mean reversion strategies. I was like, I want some mean reversion strategies. So I went to, it was Cesar Alvarez. He has a website where, and he's a fairly popular trader, educator. He wrote a book with Larry Connors years ago. I think he actually worked for Larry at one point. But he had all kinds of ideas for doing mean reverting trading, you know, oh, do this, do this. So I just coded up a bunch of stuff and I said, hey, I'm going to test it. I added some stuff. And then you don't have to be real creative. Now you certainly can be, but you can do things like that, or take just standard candlestick patterns and say, hey, I'm going to combine this candlestick with a simple breakout, see how it works. And there are just so many ideas to test. You don't have to think of ones on your own. There's a lot of things out there already that you can just kind of modify, so, which is really kind of neat.
Yeah, I totally agree. You know, I thought you brought up a very good point, you know, when you're talking about, you know, LeBron James and Tom Brady. I mean, nobody starts off doing this knowing anything.
Right. Absolutely. I mean, it's you got to learn, and the way most people learn is by doing it and failing, because it's the weird thing about trading. It's so easy to open an account. I mean, basically, you have a pulse and money, and you can open an account, and here you go. Here's the platform. Start trading. You know, it's especially now with Robinhood for stock trading, you know, people can open it up and start trading immediately. And I've talked to more people over the past few months who never traded anything before, who now think they're experts. And it's just crazy, because yeah, everybody's an expert when there's a bull market like this, but there's going to come a time where it's not so easy. And then that's when you're going to realize, hey, if you learn stuff the right way to do things, it's going to pay off in the long run.
Excellent, man. This one's really good, I think. Where was the turning point in your algo trading, and what were you doing wrong?
Probably, I've had a bunch of turning points, and if you've listened to my webinars, I always say this is where my trading turned. And a lot of them, they were like little turns, you know, where I started doing things differently and things got better. But as far as like just pure algo, once I figured out that two things. Once that I had to include slippage and commission in my trading tests, that was a big thing. And that less optimizing was better, because I did the typical optimized everything and looked at it and, oh, it looks great, and or I'm going to go back and tweak it. Once I learned not to do that, and I remember one thing in specific, I was going to say specific, I wanted to create a Euro strategy. And so I wrote down my goals, because that's important. I said, I want a Euro strategy that has this kind of, I think, return and drawdown. And then I came up with an idea and tested it with just about no optimization. And lo and behold, it met my goals. And I looked at the equity curve and I'm like, I don't know if I really like this. And immediately I went into tweaking mode. You know, I'm going to tinker with it, make it better. And I had to go back and I looked at my goal and I said, wait, my goal was this. I just created something that meets my goal. Stop creating it. This is it. Just go with it. And that was the first time I did it. I'm like, oh my gosh, I can't believe I'm doing this. I can't believe I'm stopping when I know I could make the system better. Yet I did it, and then I went on to trade it, and it did fairly well. Where if I had gone back and tweaked it, I would have gotten a better back test. I would have felt better about the system, but most likely it would have done a lot worse in real time. So that was a big kind of light bulb moment that, hey, you got what you wanted. Don't try to make it better. You know, it's kind of like if you were dating and you found a partner that is really great, and then you think, oh, I could marry this person. Then you think, well, but maybe there's somebody else better at the bar. Maybe I should go there, and you know, you risk it all for something that might not happen. It's probably a bad analogy, but you get the point. You know, at some point, you got to be content with, hey, I got what I wanted. I'm just going to go with it. And that for me was pretty big.
Excellent, man. All right, I think we got time for one more. You know what? I like all of us. You started off as a discretionary trader, and one question I like to ask people that have been doing this for a long time, and you've been at this for 30 years plus, I think. If you could go back in time and give yourself some advice, any advice, knowing what you do now, what do you think it'd be?
It would be to, one, not optimize as much for algo trading. Two, never meet a margin call by wiring more money. There was a time where I was trading wheat where I literally was going to the bank about once a week to wire money into my account because I kept adding on as the price of wheat was falling. And get this, I ended up knowing the wire transfer lady at the bank so well. She was an older lady that I started buying little toys for her to give her grandson. How messed up is that? I mean, like, oh my gosh, what was I doing? And at the time, I'm like, I am such a nice guy. I'm giving the wire lady, her grandson, little toy cars and stuff. And I'm like, that's just bizarre. So in the heat of the moment, there were a lot of things I was doing that, looking back on, I'm like, oh man, I was just an idiot. And the fact that I ended up with any money left to trade was pretty amazing. So, you know, on the algo side, it had to be over optimizing and just doing too much. And on the discretionary side, it was fighting a losing battle and just adding money when all hope was gone. Those are probably the two biggest things.
Fantastic, man. Hey, great presentation. I think we got to wrap it up here. About out of time. I think we'd like to hear from Terry, though. You know, Terry, you out there?
Yes, I am.
All right.
Awesome presentation. Thank you, obviously, for spending time with us this evening. And I just wanted to give a shout out to everyone for the last 4.5 years. Thank you all for the 400 plus webinars. It's been an absolute blast. Shane, you did a great job, great voice, and I am absolutely excited for 2021 with Futures.io.
Cool. Well, I can't believe you've been doing it for 4.5 years, Terry. I mean, it seems like just yesterday we were first talking about doing a webinar, and so,
absolutely.
You know, thanks for all that, because it's a lot of work. People don't realize, just to organize it and make sure stuff's running, it's a lot of work. And I know you're still going to be doing stuff with Futures.io, so
absolutely, yes. Yep.
It's not like he's going to be forgotten, but it's a testament to you know, your help and Shane's help that keeps this site running, which is really awesome.
Awesome. Thank you. And everyone have a good night.
Yeah, not forgotten, just under the radar, right?
behind the scenes.
You got it, man. All right, folks. I think we're about out of time. We've got to wrap it up here. Be sure to join us for our next event on Thursday, February 18th, where Jeremy Tang with Shark Indicators is going to be discussing managing trade orders and code. We're going to get a little more code action going there. And don't forget to hit that like button on YouTube, man. Head on over to Futures.io to continue the conversation. All the questions that were asked in the Q&A session that didn't get addressed, we're going to post them over there, so you're going to get some answers for sure. And again, I want to thank you for joining us. Thank you so much.